Today, I'm Mark Wilsmann, by the way, with MetLife Real Estate Investors, where I oversee our direct real estate investing programs. And with us today, we have Ken Rosen of the Rosen Consulting Group, Kevin Thorpe from Cushman and Wakefield, and Ben Breslau from JLL. So three leading folks. We're going to actually I'm going to do it right now. Let's maybe just talk a little bit about your platform and your kind of quick introduction to kind of give people context for some of the comments that you're going to be making.
So I have two jobs. I'm at Berkeley and run the Fisher Center for Real Estate and Urban Economics, which is one of the leading research centers. We've got 238 companies who are members of that, and we have our semiannual meetings at Pebble Beach, so it's always good news. On Rosen Consulting Group, we have 70 clients, leading insurance companies and banks and others, who we provide forecast with on the macroeconomy and real estate by markets and submarkets by property type on a global basis. We manage no more money. I did manage money for a long time, so we have no conflicts. We tell the truth.
So Kevin Thorpe. Hello, everyone. By the way, it's an honor to be here. So Chief Economist for Cushman Wakefield. I think everyone's probably pretty familiar with the platform. Global real estate services provider. After the merger with DTZ, we now have 43,000 employees in 60 different countries, and we provide all the sort of the core real estate services that I'm sure you all are familiar with. So happy to be here.
Ben?
Hi, Ben Breslau with JLL. I run research for our company in the Americas, part of a big global research platform. We have about 450 researchers around the world tracking and analyzing real estate markets to help advise both investors and occupier clients in the market, and based out of Boston, and excited to talk about what we see.
Great. So we're going to start out here by running through a portion of the high-level results from the consensus forecast process, and then engage our panelists on their views. So we'll get started here. So first of all, this is real GDP growth for the U.S., and to orient you to the slide here, the yellow bars are the past 12 years of actuals, and then the green bars are the next 3-year projections, so 2015, 16, and 17. And then within the green bars, you can see that there are arrows, downward arrows in this case, and that really just references the change in the forecast from the last time that ULI polled these leading economists. So relatively stable outlook here for GDP, 2.4% for this year, and growing a bit in 2016 and 17. That's down a tad from the last time the survey was done, but not significantly. Next, the unemployment rate forecast. Again, you can see the 12 years of history projected to hit 5% by the end of 2015, and then to trend down a bit further in 2016 and 17. So a pretty healthy employment outlook. Employment growth, which is certainly in real estate, job growth is a driver for demand. We've had a fairly steady job growth, looking at 2.8 million jobs created in 2015, and then staying at close to that level. We talk about more than 200,000 jobs a month kind of pace, but as you can see, a little bit of downward adjustment for this year, as well as 2016, and then 2017 actually slightly upward. Inflation, consumer price index, very low levels of inflation in the current environment, projected at just 0.5% in 2015. But then you see moving up to the level 2%, 2.2% in 2017, which of course is then hitting the Federal Reserve's kind of inflation target. 10-year Treasury rate projected to finish the year at 2.4% this year, rise modestly next year, 2.8%, and then 3.3% in 2017. So beginning the upward movement in the 10-year Treasury, but relatively modest movements, 40 to 50 basis points per year. Cap rates. So this is the NCREIF average capitalization rate, projected at 5.2% in 2015, which interestingly is sort of a record low if you look at the last 12 years. And then slowly beginning to rise, projected in 2016, and rise a bit further in 2017, but still staying, relatively low on a historic basis. Commercial real estate transaction volume, so projected to hit $500 billion in 2015, which would be the highest year in the last 12, except for 2007. And then interestingly projected to stay at that healthy, active pace for the next 2 years. CMBS market, and this is certainly kind of one of the debt capital sources that has been volatile over the recent past. You can see, again, driving a huge amount of activity back in 2007 and then dropping off to just about nothing. And then it's been slowly recovering really since 2011, projected to hit $110 billion this year and then grow a bit from there. So, and I know there's been, certainly some more recent disruption in the CMBS market that may change this. But again, this data is quite recent. Moody's RCA Commercial Property Index, so this is sort of the price index, annual change in prices, robust 10% upward in 2015, but then projected to tail off a bit in 2016 and 2017, but of course still stay positive. Equity REIT total annual returns, and this has been, kind of a choppy ride. Certainly a, very strong year in 2014, and then a much weaker year this year. And I think, Ken, we're actually negative at the moment. So the consensus forecast is +1 for the year, and then kind of mid-single digits. And NCREIF total annual return. So this is both income and capital appreciation. It's been a good run in this index since 2010, and it looks like 2015, the consensus is, will stay at almost 12% total return, but then trail off to the high single digits in 2016 and 2017. So we're going to stop there, and maybe just kind of a first question to the panelists before you interject your opinions about this. Just how would you characterize this outlook that's reflected among these, the consensus? Ben, you want to take a stab at that?
Yeah, I mean, relatively optimistic, obviously for real estate, and it's in keeping with the theme of kind of lower for longer on a lot of fronts, right? A little lower, where that elusive 3% GDP number doesn't get hit at all in the forecast this whole cycle. If you believe this forecast, inflation stays pretty low and interest rates stay pretty low. So generally kind of that lower for longer, which is a good thing for real estate.
Right, good. Anybody else want to?
So my view, I'm kind of in line, I guess, with that consensus.
I'm not asking you that yet, though, because we're going to get into that next. So just how would you characterize it? And, so positive, I think, is
so
right.
It's positive.
Yeah.
And it's cautiously optimistic. I would actually argue that we're erring on the side of underestimating growth.
Okay. All right. Well, let's just maybe quickly poll the audience. When you see those numbers, how many people think that forecast is too optimistic? Raise your hand. Show of hand. How many people think it's too pessimistic? How many people think it's about right? I guess that's what kind of makes a consensus.
Isn't that what consensus means?
So, go back to Kevin. So, what do you think are some of the underlying drivers of this generally positive forecast?
Yeah, I mean, so when you kind of take a step back and just say, okay, what's GDP growth? I mean, in some ways, if you sort of throw out you guys don't know about the sort of the cold weather, but the weather that we've had, the unusual winter weathers for the past couple of years, you throw that out, real GDP growth's actually been averaging 3.7%. So it's actually very robust. It's 100 basis points faster than the growth rate we observed during the last real estate boom. And then you say, okay, so that our baseline might be a little bit higher than what we're maybe currently assuming. And then you throw in, well, there could be a boost in growth that eventually comes from low gas prices. Right? That sort of was the expectation going into this year. The energy sector has actually been a drag on GDP growth because it directly hits business investment in the oil industry. But it's expected to be a net positive. Gas prices, $1.10 lower today. And I think really the missing link here between a GDP number of 3, 3.5, 4 is wage growth. Right? We're all waiting for wage growth to kick in. And if you sort of say, well, the economy's the rate of job growth that we're getting and where unemployment is, we're almost nearing this point of full employment. We should see wage growth start to accelerate, and that could drive consumer spending, more job creation, and a stronger backdrop for commercial real estate. So that's kind of why I say we may be, maybe underestimating near-term growth.
So how about kind of the real estate numbers in there, kind of the general market real estate numbers, which are kind of positive?
I think before we ought to have the other view.
Okay, good.
So I don't disagree with some of what Kevin said, but I think we may be in for a bigger risk than we think on the overall economy. Major risk is global. The global turmoil in emerging markets in China could well feed back not only in the trade route, we're seeing that already, and that's some of the headwinds we're seeing in manufacturing, but in capital markets. Right now, we've seen a little bit of that the last month, where stock market very volatile, bond market very volatile. We could see more of that. That many of these emerging market countries, the companies borrowed a lot of money in dollar-denominated debt. And they're commodity-based companies, mining, other things. And with the sharp drop in their currencies, the dollar debt has risen dramatically. And so I think we're going to see rising defaults on a lot of these companies and problems. China's slowdown is not going to reverse quickly. So could the capital market feedback lead to something like a contagion effect that happened in 2008, 9, and 10 here? It happened because of the small little subprime sector. It was only $400 billion, and all of a sudden it metastasized. So I think there's a risk on the downside that domestic economy, as Kevin said, is great, but the global economy is really bad, and could it feed back and change things? And the second risk, I think, is political. President Trump will put the country in a depression, or Farina, or Carson. I mean, might as well give up. But I serious worry about the political process going through next year. So I think we do have a worry that 2017 could be not better than 2016, but a correction year. And the last thing to say, the consensus numbers show job growth 2.7, 2.8 million. We're going to be at 2.1 million or lower. We have a shortage of labor. We can't find enough people to hire. So we're already seeing a downsizing in the growth rate and jobs. So that's important to real estate because that means less job growth could mean less demand for space. So I think there are some downsides as well as the upside that Kevin has talked about.
So you threw a whole bunch of things on the table there, which is
Can
that's good.
Can we continue the conversation?
Yeah, sure.
So, and don't disagree with many aspects of that, but, and I agree on the job growth number. I think that's rosy for the exact point that you made. It does reach the point in a maturing expansion where job growth businesses find they have a tough time actually hiring people. So we should lower expectations on job creation. Should still be enough job growth to drive greater demand for commercial real estate space. I want to go back to the point about so global turmoil and sort of the impact that would have on the U.S. economy. And I don't completely agree that there's a major downside risk. China's economy, the data is so opaque. I don't know that we really know sort of the extent of what's happening in China. I know that our business is doing well, and I know that they have, in theory, a lot of fiscal and monetary resources to stimulate growth there. But that is absolutely a downside risk. But I would point out that if you go historically, there doesn't seem to be a strong correlation between global turmoil and the performance of the U.S. economy. And if you kind of go back for the past 4 years, what have we had? So we had the Russian-Ukraine conflict. We had the Greek debt crisis. We had ISIS emerge. We had deflationary pressures in the Eurozone. Right? All of this stuff is going on. What did the U.S. economy do? We have gone through stretches of 4 or 5% GDP growth at times, created 12.5 million net new jobs. The Dow has more than doubled since the Greek debt crisis began. Right, so I think there is a certain amount of resilience to the U.S. economy. My fear is actually on the monetary policy side. That's where I think that's, and hard to predict with any precision when that may take us down, but I think that's the great unknown.
So Ben, you want to get into I'm kind of curious in terms of, the China thing. So there's been
Yep.
a lot of discussion around that. So, can the U.S. economy still do well despite a slowdown in China? And and if there is a slowdown in China, what impact does that have on U.S. real estate?
It's important to say that it's 56% of the world's economy is emerging markets, including China. So don't just say China. It's a lot of other countries. It's
Yeah.
really...
And I actually think the bigger risk is not necessarily China itself, although what China's doing, by the way, is everybody looked at the 30, 40% stock market crash in China and assumed that China, that's an indication of the hard landing. If you actually statistically correlate the Chinese stock market with the Chinese economy, you get like a 0.3 correlation. So you're better off probably trying to flip a coin to predict which way the Chinese economy is going, as opposed to looking at the stock market. And that's actually true for U.S. equities markets too, which have many more corrections than you have recessions, right? So the equity markets move for a lot of different reasons, risk on and risk off, and sentiment fears of investors. The second thing is, some of what's happening in China, I think, is the shift from the export, investment, manufacturing, kind of low-cost type economy to the services economy. All major economies in the world have gone through that. Japan went through it, the US went through it, Europe went through it. It's not always a smooth ride. It won't be a smooth ride in China, exacerbated by probably the political environment. But I would not bet against Chinese growth over the medium and long term, personally. There's a demographic trend there and a migration trend that's hard to deny. And also just the fact that if you look at, some of this is the law of large numbers. China's growth over the past year in absolute numbers, again, if you believe the figures, was actually double the amount that it was 10 years ago when it was the miracle of the BRICS. So some of this is just the law of large numbers. But I think the U.S. could see a little bit of impact, and we haven't really seen it yet, but I think you will see some leasing market impact from not just China, but the global slowing of growth in general. And it'll hit manufacturing, export-oriented sectors more than the overall. I actually think you may see a little bit of positive if, in fact, the domestic economy, which I think it can, powers through this global blip. I think you actually may see a little bit of a positive feedback loop on the investment side, where, once again, the largest, most liquid investment market in the world, the safe haven market, and by the way, the market that has growth rates of the developed, sort of safer places that are higher than the rest of the world, I think you'll see some jitters, but you may actually see a little bit of a positive feedback loop on capital flows.
You guys agree with that or not?
It's certainly been the case, so far. So whatever angst there is globally seems to drive capital flows back to the U.S., drives interest rates down, drives commercial real estate values up. So that's certainly been the pattern.
I think that's the base case, but the negative case is China is now liquidating its treasuries to support its currency. Many other countries in the world have big deficits, Middle East in particular, and they have to liquidate, again, their assets to support their currencies or support their economies. So I think the base case is, I agree with both of them, that it could actually lead to more safe haven money, but the risk is that they have to take their money home because they need it. And we're seeing signs of that already in the Middle East and in China. And if that happens, and the Fed also starts normalizing rates, we could see the 10-year bond, which is 2% today. I think the forecast that you saw there is it jumps to almost 3.
3.3.
And I think that is my base case. I'm shocked that other people agree with me because no one else has agreed with me for a long time. So maybe it will happen this time. But I think that's the risk, that the rise that we see, we forecast in the consensus is correct and could be exacerbated by this. But there is initial capital flows that I think safe haven stuff certainly is in the wind right now.
The one comparison, just to throw it in, that's a little, Kevin mentioned some of the kind of global headwinds that we've seen in this cycle. The one comparison that's not perfect but is interesting is the '98 Asian financial crisis, where there was a lot of concern around the world. And if you look at exports, took a nosedive. U.S. exports took a nosedive in 1998. But exports are only, 10 or 12, 13%, whatever it is of the economy. And the domestic demand stayed pretty strong, which I feel like that's the key question. Can the domestic demand withstand this global slowdown? And in that situation, you had another 2 or 3 years of obviously very strong growth driven by tech. So there's some similarities, I think, with where we are in this cycle.
So we've seen the public equities markets kind of reprice. We've seen spreads in the debt markets expand. Are we going to see similar repricing in the private real estate market?
Let me start that there's a disconnect between the public and private markets today, as you know. Really good companies are selling at 15% discount to their underlying asset value. And this has happened, I have a graph to show it, but it's not up here. It's happened in the past about a dozen times. It's not a leading indicator, I don't think. But the public markets are very nervous. They move with the S&P to some extent, and they also move with the fear of rising interest rates. I think those two things are what's causing that uncertainty. And stocks are down about 15% from their peak. They're only down 3% for the year, but 15% from their peak. And that discounts to asset value. Private side, we've had this capital flow from a lot of your clients, but also sovereign wealth funds. We've had a lot of money flowing in. And I think that people are searching for yield. Individuals are using private REITs. They're searching for yield. Because when the base treasury rate's 2%, your bank account's yielding nothing, 4% looks pretty good.
So you were talking about the REIT market and sort of the arbitrage opportunity potentially between where the public markets are pricing REITs and where the private market is pricing real estate. Is that, are we going to see a wave of privatizations?
Well, we've seen one big one, home properties taken by Lone Star, and that was really not the discount. It was the fact that the leverage is too low. Many of the major apartment companies have leverage in the 25 to 35% range. None of you running a private company would ever have such low leverage on an apartment portfolio with debt to where it is. So that could happen for that reason. I think another 15% drop, and I'm sure some of the big funds will think about it. I think at this level, with a fairness opinion and everything else, it's hard to get the discount, capture it. But if there were another 15% drop because of global events that caused the stock market to drop and REITs drop with them, I think it might be interesting. On the day in August, you remember the Dow was down 1,000 points. REITs were down 5%. Nothing had changed in the real estate market. So if you got up early in the morning and bought some REITs that day, you did very well.
So I just noticed that Ben, his equipment wasn't working, so I think maybe we should ask him to repeat every point that he's made up to this point.
It's a bad sign when they're trying to de-mic you on the panel.
So real quick on the correction in the stock market, is that going to lead to a correction in real estate prices? And I agree with a lot of what Ken said. We've sort of come at it from a different angle, so I think just not necessarily would be my response to that. And so I think another way to look at it, though, is so much of the improvement in the economy, especially in this recovery, has been driven by the wealth effect, which links directly to rising stock values. And so if stocks go down hard, then you'll see consumer spending go down hard, economy goes down hard, absolutely damages the leasing fundamentals in that scenario. But I agree that it seems so far to be, the stock market just overreacts sometimes to daily news and uncertainty, and it moves so quickly. Real estate moves much more slowly. So far it looks like it's contained, this correction's contained in the stock market. And the correction hasn't been that bad. It's actually been fairly benign if you kind of think about the run-up that we've had in the stock market.
Yeah, I think what you'll see is a higher volume of stock repurchases on the REIT side, right, where they think there's probably good value. I think this is at least the second or third correction in REIT prices in this cycle, just in the last 5 years. Right. And you haven't seen private side follow.
So let's talk a little bit about another one of the drivers of the U.S. economy and sort of the whole energy market, oil market, and what is your outlook for oil prices? What is your outlook for how that will drive real estate fundamentals and then potentially capital flows from countries that are kind of oil-rich countries?
Well, I sort of answered that already, but I think oil prices are low for a long time. The U.S. revolution, which is spreading everywhere, means there's going to be excess supply unless there's an event in the Middle East that disrupts things, which could happen with everything going on there. I think oil is going to be in the 40s, maybe goes to 60, but doesn't go much higher unless an event happens, and it could well go to the 30s. So I think lower for longer. Big problem for the Middle East, money flowing here. There'll be less of it and having to repatriate it. And our energy belt, as you know, I gave a speech on Houston, said it was a bubble. I think Houston went from 4% job growth last year to 0 now. I think it's got a digestion period. And at $30 to $40, $50 oil, there's more cutbacks coming.
So Houston is no longer the sixth gateway market.
I never believed it. I argued with many of you, and argued with Richard Rainwater. Houston is not a place for a long-term investor. In and out, not long-term.
The two things I remember, this is 2 or 3 years ago, debating with some people in Houston was one that oil prices would never come back down, and the other is that Houston has learned the lesson from overbuilding. And I thought those were pretty easy arguments to make at the time, but yeah, we've seen a big jump in availability in Houston, and although landlords are trying to hold asking rents as close as they can to where they were, the street level deals are definitely taking a hit. I think we have seen something like 5 or 6 million square feet of full floor sublease availabilities hit the office market just this year in Houston. And we've seen, similar thing in Calgary, which has a huge exposure. I think rents are down a good 15% or something there. Was even a quicker correction. Other markets that have exposure, that are big markets, I was in Denver a couple weeks ago, a bit more diversified and seems to be kind of chugging right through. And, when I think about oil prices down, the first thing that I think about is what I'm paying at the pump. And to Kevin's point that he made earlier about the overall economy, it feels like that pass-through from consumers hasn't really hit in terms of purchases and sales, and it's probably hit the confidence numbers, but hasn't actually hit as much in terms of pass-through to the U.S. economy. And it feels like if oil stays lower for longer, then it's coming.
Do you agree with lower for longer?
Yeah, I do.
So my view is I'm not sure anyone has any idea really where oil prices are headed. We studied that, and you can argue it's sort of either scenario. I'm more in Ken's camp, I think in your camp. It's a good parallel to draw is the oil glut of the 1980s. And I think people maybe forget about this, but oil prices stayed below $20 a barrel for 15 years, right? And so, given this this fracking, this sort of a supply dynamic that we've never really seen before, it's very difficult to predict. We're sort of focusing on the concentrated pain in the energy producing markets, right? So parts of Texas, parts of North Dakota, Colorado, but I do think that it's overall, what we're saying is a net positive for growth. It hasn't really kicked in though, right? We were kind of saying that earlier in the year and still waiting for that to show up in the consumer spending, and it really hasn't.
They're spending it at restaurants. They're not spending it on the things that we thought they would, retail. They're not spending it on goods.
And particularly housing, big ticket items like for
But they are spending it on cars and trucks.
Yep.
That is the one big benefit. This is record level sales of cars and trucks. And they're buying the gas guzzlers again.
So let's talk about another driver in the U.S. economy, and that's been technology and the growth of technology. And of course, we're in San Francisco, the heart of it all. Are we in a tech bubble, or is this kind of a driving, sustaining growth engine for the U.S. for many years?
You're saying, is this time different?
Yes.
Trees grow to the sky. Well, we're in the biggest boom San Francisco's ever seen since 1849. Much bigger than the late 90s. The late 90s, we grew about 30,000 jobs a year in San Francisco and 30,000 more in Silicon Valley. We're at 50,000 jobs a year now in both markets. This is driven by, I won't say exclusively, but certainly 80% tech and media related. But tech is very different than it used to be. It isn't hardware, it's software, it's apps, it's advertising. Facebook and Google are advertising. They're taking stuff from mainstream media and getting the advertising revenues. Apple, of course, is hardware and software. I look at this and I get very scared because I lived through we had two previous bubbles, not just one, two in San Francisco. And Everyone thinks trees grow to the sky. Every young person graduating from every major university wants to come here. They don't want to come work in real estate. They want to come work and get in a startup and make their $1 million or $1 billion. We have 129 companies in San Francisco that have over $1 billion valuation private. They're called unicorns, fantasies, and have no profits, no profits. You probably took one to get here. And you're going over to the headquarters of another one. So I think that we have more to run, but it's driven by the huge availability of capital and the transformation of society where tech and apps are part of everyday life now. So it's different this time. It's going to last longer, I think. It has more to go. But in the end, there will be a correction when capital markets say, no more. You've got to make a profit. I was on the stage with a major person last week of one of these companies. He has a $5 billion valuation, $600 million of revenue, and he was asked the question by the CIO of an insurance company, when are you going to make profits? He said, that's not our plan. That's not what Wall Street wants. So I think we have more to run, but there will be a big correction in all the tech markets when everyone trying to scale doesn't make it. 80% of the companies that are trying to scale won't make it. But the Facebooks, the Googles, the big companies, Apples, still have a lot of revenue and a lot of profits, and they will be here. So different this time, but there will be a correction.
And do you see San Francisco as different from the other tech markets, like New York? New York's, a lot of their growth has been from technology. Certainly Austin is booming, et cetera.
I think we're more vulnerable here because that's all anyone thinks about. And I noticed half of you are on your devices right now. But it's all anyone thinks about here. So it's a boom of unprecedented proportions. It's twice as big as last time, and it just never ends well. It's not going to be nice, stable growth constantly. It just doesn't work that way in San Francisco. But we might have 2 or 3 more years to run before the capital markets say no.
So what I think is interesting about, I think the correction will be more severe in San Francisco. That if you actually just look at office rent growth in San Francisco, it's up 110% since 2010. It's a massive run-up in office rents. Nationally, rents are up 7 or 8% over that same period. But what I think is interesting, so I came across an article from The Economist magazine, and the title of it was, "Is this another tech bubble?" And they talked about, irrational exuberance is back again in the internet, and investors beware. So that article was written on and published on May 12th, 2011. So 4 years ago. So just sort of think about what's happened in that 4-year period, right? Northern California's created 450,000 jobs, the run-up in office rents. The NASDAQ has gone up 70 or 80% over that period. Tons of robust absorption, linked to tech. So I don't know. Is it a bubble? I mean, probably. There's probably multiple bubbles actually out there right now because of monetary policy. But what do you do with that, right? I mean, this thing could go for another 2, 3, 4, 5 years, 7 years.
No,
and
7 years not.
But how
It's a 7-year cycle, so it can't.
How
Ken,
do you not
an app
have
for
tech
that.
in your real estate portfolio given that robust growth? It's just,
I think you hedge. So if you think you have an anchor tenant and they have no credit, but they have venture capital money, you can hedge that. So you try to hedge your tenancy.
Right.
You have your tenant, but realize that they're probably going to go under.
I think the only thing I would add, I guess, is just coming at it from a little bit of a different angle in that, tech, I do think the bubble is going to probably be the same because you get to this point in the cycle and you get a ton of capital coming for high growth and people forget about unnecessary things like profitability. But I do think that there's some fundamental differences this time in that there are real significant changes to society, to business, to consumers in terms of how we function. There's the mobilization and the automation of not just the tech world, but of the regular world. So tech used to be this niche industry, hardware, software, mobile, social, and now it's ubiquitous. You can't talk to a financial services company without fintech coming up, or a healthcare company without, all the doctors are on iPads, or a manufacturing company about robotics. Think about retail and industrial with e-commerce. Heck, real estate companies, simple bricks and mortar real estate companies, we're now a tech company to some extent, which is scary for everyone. But we're now a tech company to some extent. We're tracking hundreds of companies that are coming to do things in our space and probably spending hundreds of millions of dollars on tech ourselves. So I do think that tech has come mainstream a bit. So that doesn't mean there won't be a bubble, but it does mean, I think, that that type of talent the companies are going after, not just tech companies, but mainstream companies, and how that impacts how people work and how that impacts where they want to live, is more of a secular trend.
Very good. Well, let's shift gears and talk about another, certainly key driver of the economy and real estate values, and that's interest rates and what's going to happen there. So, give us your views on what the Fed's going to do and how that is going to impact both short and long rates and ultimately real estate valuations.
So I would just say the Fed is behind the curve. I was really surprised they didn't move in September. They used China and emerging markets, which have already been cratering before that, as an excuse. But I think they've told us what they're going to do. They have the dots. They give us a forecast. And their normalized interest rate at the end of this year is 25 basis points, which they still think they're going to move this year. Next year, it's 1.25. And in 2019, it's 3.5. So the Fed has told us, their own people have told us, they give these forecasts every quarter, and the market doesn't believe it. The market does not believe it at all. The market thinks the Fed is wrong, that the economy is not going to be strong enough to raise rates. On the 10-year bond, there is a forward forecast on the market that says the 10-year bond in 2019 will be 273. It's 205 or 6 today. So I think our consensus forecast is more right than the market, and I'm glad to see that consensus, but 90% of economists have been wrong. I've been wrong 100% of the time, so I'm humbled by the fact that rates have been so low for so long, and I think it's a mistake, but they're still doing it.
Yeah, I think the market has backed the Fed into a corner to some extent, and I think the Fed's drive for transparency has backfired a bit in that the markets are reacting more on the guessing game than they are. I think the U.S. economy is strong enough to handle a quarter point, as long as it's followed by a very gradual path forward that's articulated. It takes a year or two for that to go into the real economy anyway, but the markets are spooked. And they've backed the Fed into a bit of a corner. So if you think about, to me, the case for and against the rate hike, the case against maybe that there's still slack in the unemployment rate and all this global stuff going on. The case for, to me, you've got more people employed in our country than ever before. You've got more goods and services being produced than ever before. You've got higher corporate profits than we've ever seen before. And you want the Fed to get ahead, so there's a bullet left in the chamber at some point down the road when we do go into a correction, which I think we all agree is sometime in the next few years, not the next 10 years. And so I think the Fed should but won't, in my view now. That's what I thought in September, and I still think that. I think they should but won't.
So Kevin, with that backdrop, what's the outlook for cap rates and total returns in real estate?
So first, let me say yes, I suspect we will continue to have interest rates next year. I also suspect we'll continue to have interest rates for the next 5 years as well.
Low or high?
Go out on the limb, yeah.
So here's, I think, an important point. I'll get to the cap rates in a second. So I think it's important to remember that the Fed does not control long-term interest rates. Right? It's like sort of a common misconception. They can influence long-term interest rates, right, through open market operations, but it's really inflation expectations at the end of the day that dictate long-term interest rate movements. And so as well as sort of the global context, what's inflation doing globally? So I think that's kind of important point. Even if the Fed moves forward with raising interest, I agree they should have in September. It's never going to be perfect, right? Even when they move forward with raising the Fed funds rate, and I think they're going to do it in December, the wage inflation data is really important. It comes out on October 30th. If that actually goes up towards 2 or 3% again, I do think they're going to raise in December. Even when they raise, it doesn't necessarily mean anything for the 10-year Treasury yield. Doesn't necessarily mean anything for cap rates, frankly. And I think that's another when you sort of look at cap rates versus interest rates, infinitely more important than interest rates is growth. If you actually run the relationship of NACREIF returns to the 10-year Treasury yield, not that strong, not that big. What is strong is GDP growth. So if you think about it, even if interest rates are rising, long-term interest rates are rising, That's likely to be a function of a more robust economy, meaning higher rents, lower vacancy, better NOI, better debt availability. Kind of all these things should be driving commercial real estate values up, even in a climbing interest rate
And
environment.
in fact, real estate, to that point, real estate has outperformed stocks and bonds in most of the previous tightening cycles
Yeah.
for exactly that reason, because it typically goes along with growth.
Yeah.
Good. Well, let's shift gears a little bit here and start talking about investment strategy implications. So the consensus survey also looks at returns and characteristics by property type, and we're going to run through these fairly quickly. So again, here, these are the outlook years, 2015 in green, 2016 in blue, and 2017 in kind of yellow. And so this is annual total returns, and you can see all of them sort of tailing off to in a kind of high single-digit range. You've got industrial projected to slightly outperform and apartments to underperform a tad. This is vacancy rates, projections for vacancy rates. So you have apartments moving up very slightly. You've got industrial basically staying flat, moving down slightly. You see retail moving down a bit, and you see office continuing to move down a bit. So basically, occupancies flat to up in all of the sectors except for apartments, but apartments still pretty healthy. Rental rate change by property sector. So here again, you see actually industrial at the top of the list for 2015, followed by apartments. Office, a nice steady 4% the next 4 years, and retail growing more slowly next year, but then picking up. I'm actually going to stop there. So comment on, from an investment strategy perspective, what property sectors do you guys like and why?
So maybe I'll start, as you know, for the last 5 years, the last 10 years, last 20 years, last 30 years, I've been an apartment bull. I like apartments because the demographics are so strong that we have basically over 4 million people turning age 18 for the next decade annually. We have a lot of young people delaying marriage, delaying childbirth, wanting to live in urban cores in apartments. The apartment rentership rate has gone from 31% to 36.6%, the highest since the late 80s. And I think this trend continues for a while, certainly the next 3 to 5 years. And it's hard to build enough apartments to keep pace with this. And rent growth has been 4, 5, 6%, some markets higher. I don't think that gets worse. I disagree with the consensus here. I think apartments still look good. Certain places could get overbuilt, and I think we have to be very careful of that. So I rate apartments number one, risk-return trade-off the next 3 years. I'd rate industrial number two. Office is getting better, but office has a big problem compared to apartments and industrial. And the problem is capital improvements, leasing commissions, TIs, just cost money to roll. And I don't think it's going to be a great place, but again, it's all market specific. And lastly, I'd rate retail. It's facing the headwinds overall of the internet and e-commerce. And so everyone loves malls and high-end malls. I think they could start seeing some more impacts of that sector. The grocery-anchored stuff is still my favorite. The community retail is my favorite.
Ken, are you concerned with affordability, apartment affordability in places like San Francisco and New York?
It is a big issue. And I know the details since I have a 27-year-old son. He finally moved out of our house into an apartment, and it's $6,000 a month for a two-bedroom. Hard to believe. So he got a good job this summer, thank you, real estate industry, so he pays a third of the rent. His girlfriend pays a third of the rent, and I pay a third of the rent. It's a big problem in San Francisco, New York, and I think all over the country, B and C especially. B and C rents have moved up a lot, and those are renters by necessity. So rents have been rising faster than incomes. It is a problem, and it's going to be more of a problem as we go forward.
Ben, what do you think about the office market?
Yeah, I actually think out of all of these, the office is probably one where we were a little different than the consensus. I think you're going to see some spiky rents on the office side over the next few years, more so than people are baking in. The supply response is outside of a handful of places, Houston and maybe here and a couple other places, has been much slower on the office side. And we see tenants in the office market expanding. We track leases across the country, and continually over the last several quarters, the companies that are in expansion mode have grown, and the ones who are in contraction mode, even with the headwinds of densities increasing and different types of office usage, is really starting to come up. So we actually see office rent growth leading the pack next year, then maybe tailing off a little bit after that. But the interesting thing to me here also is just that you're in the sweet spot of the cycle from an NOI perspective. You've got generally occupancies stable or growing outside of maybe just pockets of overbuilding, and you've got rent growth across property types. So this is part of why I think the whole consensus forecast was pretty strong, despite all these negative headlines, is that when people look at their own properties, a lot of people have been predicting the fall off in apartment rents for a while, and I agree with Ken on that one. It's sort of the gift that keeps on giving. And I think there's a lot of interesting aspects in the B space now that A's are sort of fully priced. The B's are full and see a lot of rent growth too. So, we're pretty bullish on office actually.
So, follow up on office. There's been sort of this trend towards creative office space. It's kind of the hot thing. Kind of the changes in the way office space is used. Do you view that as a secular trend or more of a passing fad? And depending on your answer, what are the implications for investing?
So it depends which part of it you talk about. So when you think about the trend in office usage, there's a lot of headlines out there. Collaborative, dense, urban, transit-oriented. I think some of them are here to stay. I think the kind of looking for places that are urbanized with amenities that have a little bit more of an open plan layout and access to transit are here to stay. I think personally the density trend has probably gone too far at the far end and will swing back a little bit. I think companies are realizing that unless you're got a sea of programmers who all have their headphones in rocking out to whatever music those folks rock out to, and have their head down writing code, it's not quite as easy to be productive and to focus in kind of a bench-style open work environment. So when we talk to some of our corporate clients in terms of occupancy planning, one of the biggest things that they're coming back with now is help me program more private space, not dedicated offices necessarily, but help me program more private space back into the floor plan. So I think you have to be careful about which trends you're talking about. I think overall the search for creative, urbanized, amenitized office spaces is here to stay. Who wouldn't want to work in those environments? And it doesn't matter to me if you're a millennial or not. I mean, would you rather work in a glass box surrounded by a sea of parking off the highway with a vending machine in the lobby, or would you rather work in a building with a roof deck with character, with architectural, interest and amenities around it? That's kind of a no-brainer.
So,
Kevin, how about the industrial market? So it's projected to be the kind of the best performing. There certainly have been some changes in the industrial market. What's your outlook for the industrial market, distribution market, and kind of strategic implications?
so it's a bullish. I mean, I think bullish on industrial without question. Year after year of record absorption nationally. Industrial vacancies now at 7%. It's actually under 4% in some markets. Indianapolis, Denver, LA, so very tight. What I really like about industrial, I think might be interesting, is what are the sort of the small distribution centers, many of which have not even been built yet. So what the Amazons of the world are realizing is that these huge fulfillment centers that they've built aren't really located close enough to the people, to the population density, to make good on same-day delivery or next-day delivery. So I almost think you can draw a straight line from that fulfillment center to the city, to the people, and along that line, I believe there's going to be a need for smaller distribution centers, or maybe you convert one of those, those shopping centers into a distribution center. I think that could be interesting. And the other piece on industrial is, so it's been driven by e-commerce for the most part. 40% of the absorption is coming from e-commerce, stronger consumer spending. The missing piece for industrial is housing. right? And if housing really gets it going, meaning the residential construction side, I mean, that occupies historically 15 to 20% of warehouse inventory, right? Lumber, glass, concrete, all that stuff stored in warehouses. So if housing kicks it in here, I think we could be certainly continuing in record territory for industrial.
Great. Well, in a couple minutes, we'll open it up for questions from the audience, but I've got a couple last questions for the panelists. So this projection goes out 3 years, and it looks, as you characterized it, Ben, pretty optimistic. Not crazy optimistic, but pretty optimistic. What happens as you look out further?
Well, obviously, there's a recession in 2018. That's the next year. I joke, but that's actually kind of our base forecast. When you look at, I love when you look at a lot of forecasts, they go kind of up into eternity, like the trees that grow to the sky. But when we kind of model the future, we see a fairly low probability of recession this year. Obviously, we're close to the end of this year and next year, with sort of 2017, 18, and 19 being kind of the window, and 18 being the highest probability. It's not a, I mean, it's who knows exactly, but we look at the three things that typically lead to recessions in the U.S. are policy tightening, and we haven't started that yet. Hopefully get going soon, but it usually takes several years to get there. Financial crisis, some sort of financial asset bubble popping, and again, try to figure out where that is. Is it in tech? It probably is in tech, but I don't think it's ready to pop yet necessarily. And the other one that's far more remote, although it gets a lot of headlines, is geopolitical stuff, as we talked about, that there aren't very many instances historically where that actually causes a U.S. recession. But, so that's why we feel good in the short term. The longest expansion in U.S. history was 9 or 10 years in the 90s, and we're 6+ years into this one. So it's hard to imagine us getting to the end of the decade without a correction. And so we start to talk to our clients about investment strategies that look at if you're looking to add value, try to add it and get out in the next 2 or 3 years if you can. Development still could be a very good play if you can do it pretty quickly, but if you're looking to deliver in 18, 19, 20, kind of bigger, more complex projects, you better want to hold them for a while. Or start to look at things that are stabilized and could perform really well with income producing through the turn.
So how is this cycle playing out different than 06, 07? And if we have a downturn at this stage, how do you think it might be different?
Well, I'll start by saying that 06, 07 was, I hope, once in a lifetime for all of you. It wasn't as bad for real estate as it was for the overall economy. We lost 6.2% of our jobs. It was the Great Recession. And housing bubble was the main cause of that, but there were bubbles elsewhere. Commercial real estate was overvalued in 2007. We all knew that. So I don't think we're going to have that one again. The Great Recession, certainly not domestically. We've tightened down. I think a correction that we're going to see this time will be a growth correction. So a more mild recession. I think it could be 18, it could be 17 with the new president who he or she might decide to do some things that are not so wise. But 2017, 18, 19, I think is the time frame. It'll be a much more moderate correction, more like what we had in 2001 to 2003.
Kevin, you want to?
So just for perspective, I mean, realistically, when you run, we all run econometric models to help us figure out where things are going. I mean, you really are, once you get beyond 18 months, very difficult. I mean, maybe that's why you designed the survey to only go out a certain length. I mean, who's going to be president? I mean, who could have predicted that one of the greatest periods of fiscal austerity in this country would come under when President Obama was? Who would have predicted that one of the greatest periods or biggest periods of government spending growth would have occurred under George W. Bush? But 9/11 happened, Department of Homeland Security was created. So, the further you go out, you're really starting to guess. And that's why I'm guessing most of our forecasts sort of revert back to the mean, once you go past a certain point. The point I would make, I guess, so how long can this expansion go? How much runway do we have? What's different is monetary policy. So we've never seen the global central banks do this before. We've never seen the global M2 money supply go up by $7 trillion in such a short period of time. And that changes the dynamic. That may suggest that this expansion could go longer. Financial system probably has never been this sound before, but it also suggests that maybe growth will be really slow, right? Slow growth, not big returns, but maybe a longer expansion.
Which is pretty good for real estate.
Which is good for real estate.
The only other point I'd make on the difference, Mark, is that one, I think from a real estate perspective, is that there's more equity in general across the landscape. It doesn't mean that there aren't pockets where people are getting maybe too aggressive, but there's generally a lot more equity in place in the commercial real estate landscape, which is a good thing. But there's also a lot more debt in the world. There's this McKinsey study that came out earlier this year that tried to quantify all the debt. This shocked me, $57 trillion more debt today than there was in 2007 in the world. That's not real estate, that's just overall. So we got to the end of 2007 into 2008 and 2009, we were supposed to have the great deleveraging. And a lot of that's been on the public side to support economic growth, and some of it's probably in the shadow banking system in China, which is a little scary. But that's, I think, the difference from this cycle to last cycle.
Great. All right, let's open it up for any questions from the audience. We have a microphone here and a microphone there. If you could step up, that would be great.
I don't think you can talk about global growth really enough, because everything else kind of seems like drops in the bucket. About a year ago, the IMF released a study that was pretty ominous on global growth, and just a couple days ago, they said that it's looking like it's going to be like 2009 going forward in the global growth area. Hypothetically, you see a world where all this foreign capital keeps flooding into the United States. How does that affect individual property types in the 3 to 4 year range? What does that world look like where the rest of the world isn't growing, but the U.S. is? And how is that going to affect individual property types?
You want to take a stab?
So I'll take a stab. I'm not sure I'm going to directly answer that. So there's also a scenario of, if you're in this camp where you believe that quantitative easing works, and this monetary stimulus works, I think maybe by general consent, I think you can see that it has had some success. So it seemed to have worked really well for the U.S. Well, then the rest of the world is now doing that too, right? So the Eurozone has this massive quantitative easing program. Japan, China, India. Right? So they're creating more capital. We're not. And I think a risk here is sort of, and this is more out 12 to 18 months. If you believe in QE and believe QE works, well, it's going to work over there too. And then you may see the capital flows actually shift out of the United States into other parts of the world. That doesn't mean all of it leaves, but I think that would create some softening, certainly in the capital markets here.
So any view on, part of the question was property types and potentially markets that will be benefiting disproportionately the next few years if we continue to have this
just broadly speaking, inflows have been from overseas have been disproportionately in big gateway markets that are large and liquid and more stable through time, and I think you expect that to continue. However, we've certainly seen, just like with domestic investors, we've seen international capital from all over the world creep out past what you'd expect in terms of their risk profile. Some of that is because they have very different risk profiles, so trying to map them to a typical fund here doesn't make sense. Some of them have generational capital where they can make it through a cycle. They can do big, large, mixed-use projects. They can buy land. They can do kind of whatever they want. Some of them are coming over here to learn the business and bring insight back, and some of them are coming just to preserve capital, where the return hurdles that we might look at here aren't really what they're looking at there. So I think you really have to look at the different buckets. I think the big gateway markets will continue to probably outperform in terms of inflows, but that next ring of markets, really across property types, I would say, and including kind of mixed-use development type projects, will be targets.
Good, thanks. A question over here?
Yeah, hi. My question was in regards to the rates market. So the growth between, I guess, 03 to 09, really, or 08, really has had a they called it the Greenspan enigma, right? Where the long end of the curve really, or the entire curve really flattened throughout a hiking cycle. Do you guys expect the same type of flattening move over the next hiking cycle, or what's your expectation in terms of the curve movement?
So will short rates move, or how will long rates move when short rates move?
Well, I would say that, as earlier stated, there isn't actually a perfect correlation. But I think long rates at the moment are being anchored by three things. I think the very zero short rates. So when we start moving that anchor, I think there is a reason to think that long rates might move up. Secondly, it's the low rates in Europe and Japan act as an anchor in our rates. And those rates also might move up. Lastly, as someone said, inflation expectations in the end determine long rates. And I think we're at the bottom of the inflation expectation cycle now as we follow this deflation, commodity prices, imports, and they're falling a lot, and they might start moving up. So I would say the short rate, we can't have an inverted curve, that is short rates are higher than long rates. I don't think the Fed wants to do that or expects to do that. So I would say that short rates will not move, not influence long rates initially, but long rates have to go back to equilibrium, which I think is, the consensus was 3.3. I think in a couple of years, I think that's right.
Good, thanks. One more?
Yes. The low yields in the U.S., do you think it's going to push investors to start looking at other markets, primarily developing markets where they can get higher yields? And if that's true, then which markets do you think are the ones that investors will be looking at?
So there's a lot of softness in the emerging markets. Is this creating an investment opportunity relative to what we see here?
In the emerging markets?
Correct. I think that's the question.
Globally, or in emerging markets in the U.S.?
Emerging markets, I mean China, Brazil, and I know it's a tough moment for those markets, but yields are probably going to be much higher there.
Maybe. That's really, it depends on your sort of risk strategy, right? If you're a risk taker, then you may be way ahead of the game, right? Because of again, I think it goes back to the monetary stimulus argument. So maybe if you're buying now, you're buying low, and if this kicks in and works the way the central banks think it will, then you're maybe hitting some good returns. I think there's emerging market opportunities in the U.S. that are really interesting, right? So now, gateway cities, cap rates are as low as we've ever seen, right? Under 4% on things. It's sort of the growth is now spreading out from the gateways, the gateway cities. So now you're really, I think the yield is going to be in the secondary, tertiary markets. The risk is there too, but the Atlantas, the Phoenix, Oakland, I think those are interesting markets if you're looking for yield in the U.S.
I'd say a lot of people would say that the correction in places like Brazil, the currency has dropped so much. People put a lot of money in there 3 years ago, not thinking the currency was going to drop, so it's in total disrepair. So if you're an opportunistic player, you might want to go where the money isn't, not where the money is. But that's for risk-loving people, realizing currency and political events are very important in global markets. It's not just supply and demand in real estate. It's much harder to do correctly.
And each of those situations is so different too, just like markets here, comparing Brazil and China were both high growth markets, they're both big populations, but they're dealing with very different things.
Well, very good. So I think we'll wrap it up there. Thanks to our panelists. Let's give them a hand.